Welcome back. Module 10, Candlesticks. Till now, we have seen up to Module 9. Technical analysis is Module 9. We have seen fundamental, macro, micro. Within micro, we have seen qualitative, then quantitative, then technical analysis. Now, we are going to discuss extensively about candlesticks. So, candlesticks, before we go into that, as always, our LinkedIn details, website details, and our Twitter and other details are given. Takeaways, target audience, as always, MBA, CA, CFA students and others. I am not going to repeat again. Of course, intraday traders, definitely derivative traders, intraday traders, and even long-term investors who wants to time the market has to learn candlesticks. Takeaways, what is the takeaway? Good understanding of candlesticks. Understanding the emotions of market, because after all market is made of emotions, perception, buyers and sellers determine the market movement. Hence, understanding the emotions of the market is very important. Art of making profits, applying candlestick reversal patterns, that's very important. Lastly, dramatic transformation in the investor traders confidence level, because we will be in a position to do trade emotionless. Let's straight away go into candlesticks. Slide 4, candlesticks. What are the various types of candlesticks? We will see first all the various types, then we will discuss each of the candlesticks. Simple candle. Within simple candle, we have Marubozu, spinning top and doji. Within doji, we have simple long leg doji, dragonfly doji and gravestone doji. Bullish engulf and bearish engulf. This is a combination of two candles. Bullish harami and bearish harami, piercing pattern and dark cloud cover, morning star, evening star, hammer and hanging man, inverted hammer and shooting star, rising 3 methods and falling 3 methods, kicker. Lastly, we end with kicker candle. Okay. Of course, before we go into that, two things I want to tell. First and foremost, different books will use different names. The usage of names is not relevant. What the understanding of the candlesticks patterns and reversal is very important, number one. Now, we will go into candlesticks. Just before that, one very important information, because history is important. Candlesticks was first invented or used, whatever name one wants to use, by Japanese rice traders some 400 years back. In fact, it is being told that they became stinking rich using candlesticks. Then you can see the power of candlesticks. What is candlesticks? Let's start. Slide 5. Simple candlestick, bullish and bearish engulf. So candlesticks, as you typically we use in our houses, lighting and other things, there is a body and there is a upper wick. In the normal white candle that we use in our homes and what we buy, we always see only one upper wick. But in candlesticks that we use in any fair market where prices are traded freely, we have 4 price points. What are the 4 price points? The opening, high, low and close of the day. So using candlesticks, we accurately capture the open, high, low and close and the high and low. How we capture the high and low? As you can see in the figure in slide 5, you have green and red candle. We will come to that what is green and red candle. There is a body, the upper shadow and the lower shadow, that is denoted by the high or the low. Okay. So first we will see the green candle. Green candle is what? Where you can see is open is lower and close is higher. Simple. That is called green candle. You have the high, which is represented by the higher, the highest point, the wick, or they also call shadow. The lower side you see the low, it is also called the lower wick or the lower shadow. Whichever name you want to use, you can use, but please understand the concept. So a body, a candle has a body, the body is denoted by red or green. If the close is higher than open, then it is a green candle. Simple. What is red candle? Red candle is just the opposite. It has a body, it has a upper wick, it has a lower wick, or upper shadow, lower shadow, as you can see in the image. So the only difference is the close is lower than open. That means the open is here, close is here in a red candle. So we denote by red. Why green and red? Some latest applications they also use black and white, but most of the applications use green and red. It's simple because we humans are trained in traffic. When we go, green means it is green, clear. Okay, green is something thought of something rising, positive. Red means something danger. Okay, hence if the market falls or if there is a fall in the price, we denote by red candle. That means the close is lower than the open. So what we have to understand is, in any freely tradable commodity or fairly tradable, okay, that means where demand and supply perfectly operates. All the players have all the information and take informed decision, that we call it as a fair market. In a fair market, there are 4 price points: the open, high, low and close. So that is denoted by candlesticks, either by red or green candle. This is the simple candle. I am sure you would have understood. Now let's go to slide 6, which is Marubozu. What is Marubozu? Marubozu is like a simple candle, excepting that there are no upper and lower wicks. It doesn't mean there are no upper and lower wicks, meaning there are no highs and lows. It's not that way. The highs and lows cannot be seen by visible, is not visible. That's the only difference. Okay, that means the open is at a lower price and the low is low at the near the open, and close is at the highest point. That we show it as green Marubozu. Okay, so it doesn't mean that a close and high are at the exact price points. Don't take a scale or try to measure. It means that it is the wick, upper and lower wick is not visible, not seen. There might be a small wick, or in some cases there might not be a wick at all. Regardless of it, Marubozu is something where in a green Marubozu, the open and low are at the same point. That means the open, it opened, it formed a low, then it went all the way high and closed at the highest point. Red Marubozu is something open and the high for the day or for the time period is at the same point. From there it came down and it closed, it came low, and the low is also at the close. That means low and close are at the same price. That is called red Marubozu. So basically you have to understand this is a very powerful candle, simple candle. Let's go to slide 7. We have shown with examples where we have encircled Marubozu. As you can see here, there is a red Marubozu which is followed by a green Marubozu. So this is an example. Okay. Let's now go to spinning top, slide 8. Spinning top. There is no green and red spinning top per se, but we have shown it. What is spinning top? As you can see here, you are seeing a small body. There is an upper wick and there is a lower wick, right? Upper shadow or lower shadow. What it means? Very simple. See, candlestick is simple common sense. Basically, you have to understand in a time period. The time period can be 1 day, 1 week, 1 month, 1 year, or 1 hour, 5 hours, 4 hours, or even 1 minute. The time period can be any, but what you have to understand, there are 4 price points, right? As you can see, the body is very small. There is an upper wick, long upper wick and long lower wick. That means it is called spinning top. What it means is it is indecision. Though we have shown 2 spinning top, just a green also and red spinning top, it doesn't matter whether it is a green or red spinning top. Spinning top is a spinning top. It is an indecision. Hence, what one has to understand is, if you see any candles of this kind of pattern, you have to understand 2 things. One is that it is called spinning top. That is the name it is given. And more than the name, what you have to understand is it is indecision. What is indecision? During the day, you think of a tug of war where the bulls and bears are fighting each other. There is no winner. There is no clear winner. Both are not giving. There is an equal fight, tough fight happening. But at some stage, somebody has to give up. But on this time frame, the time frame can be 1 day, 1 month, or 1 week, or even 1 year, there is no winner or loser. There is no clear winner loser. Hence, it is called indecision or represented by spinning top. As you can see in the next slide, slide 9, example, spinning top examples. You can see, right? On the left hand side, you are seeing 1 arrow, and on the right hand side, spinning top at the top. Both are spinning tops. Okay. Doji. This is very important. These are some of the new names for starters. It might be new names, but don't worry about the names. But what is important is understanding the concept and seeing more and more candlestick patterns, which will make you perfect and down the line you will not even be using the names. You will see the candle and you know what is the next candle that is going to form. That's more important. So there are 4 types of candle, as you can see: neutral doji, long leg doji, gravestone doji, and dragonfly doji. So while we have 4 representation, doji is a doji. Doji means indecision. So you might ask, what is then spinning top? Spinning top is indecision where there is a body. In doji there is no body. That means the open and the close are more or less at the same point or nearly at the same point. Sometimes you will find at the same price. Okay, that might be a coincidence. But what is important is that you cannot see a body. It is represented by a line. That means the open and close are at the same price points or near the same price point. There is a high and low. Natural neutral doji, as you can see on the left hand side, is like a typical plus or a cross, okay, where there is a open high and there is a open and close at the same point and high and low. And long leg doji, as you can see here, long leg, it has a long lower leg. That is why it is called long leg. But open and close at the same point, there is a high that is formed, right? Gravestone doji, as you can see in the left hand side, open, close and low are at the same point, meaning at the nearly at the same price. That means you are not able to see any difference between these 3 price points. But what happened during the period, the high, that means the bulls took the price up and they took it up, but they could not hold up there. Then finally bears brought the price down and they brought it, sometimes they would have brought it below the open and the close, open, but apparently closed at the open itself. But the low is insignificant, hence the low is more or less at the open and close. Dragonfly is just the opposite of gravestone doji, where what happened, the bulls have, the bears have brought the price to such a low level from the opening, but finally during the time period, it can be a day or week or any time, the bulls were able to manage and take the price up, but they cannot take it beyond the open and the closing was more or less at the same point. What it signifies, it tells us that during the time period there was indecision or there is a tough fight between the bulls and bears or the buyers and sellers. That is important. That means during the time period the market perception was there was no clear winner and they are waiting for a decision. That's very important. So in slide 11 you can see the example of neutral and long leg doji. You can see 2 arrows that we have shown, neutral and long leg doji. I am going to slide 12 where you are seeing an example of dragonfly doji and gravestone doji. I hope you are able to see that, right? Dragonfly on the left hand side and gravestone on the right hand side, right? Let's move on. Slide 13, bullish engulf and bearish engulf. So till now we have seen a single candle. That means all are only just one candle what it formed. Now we are seeing a combination of 2 candles. As you can see on the left hand side, first there is a red candle. What it means? The open was here, close was lower. The next day, I mean normally I use the next day, it doesn't mean it need not be the next day, it can be the next week or next year or next minute or next hour, whatever is the time period. Please understand that you make a note of it. When I use the word next day, it doesn't mean next day, it can be any time period. It is irrelevant, time period is irrelevant. At all time periods it happens. It can be even 15 minutes, okay. So first candle is a red candle, that means it opened here and closed lower. The next candle opened lower and bears took control and took the price down. But ultimately what happened, bulls came back strongly and took the price up and took the high to much higher than the previous day's candle, but apparently closed above the previous day's open, engulfing the body. That means the previous candle's body is fully engulfed, that is covered. This we call it as a bullish engulf. What is the relevance of it? It means a strong reversal has happened. Think of an IPL match, no, where teams are there. The bowling team is in a powerful position. They have taken 5 wickets. Suddenly a batsman is coming and just ting tong and he is hitting for 4-6 and he is taking the back to the opposition. Something similar to that. That is called bullish engulf. Bearish engulf is just exactly the opposite, right? What happened? It was in a bullish trend, particularly after a trend. No, the first candle you see is a green candle. That means open is here, close is here. So next day's candle what happened? The open is higher than the previous day's close. That means bulls were in control for some period. Then what happened? The high had also, they had taken the high to much higher, but they could not hold there. Bears came back powerfully and they pushed the price down so much that the low was much lower, but ultimately the closing was such that it covered the body of the previous day's candle. That we call it as a bearish engulf. It engulfed the, again, if I were to use an IPL example, a batting team was hitting powerfully, suddenly the bowling team came and took 3 wickets and put a check on the run scores, and also number of overs were going. So it's something like that. Always know stock market or capital market or anything is very simple. All I have said is many times is simple English, common sense. Okay, you apply the common themes, you'll be able to understand. So now let's see the example. Slide 14, you can see the example of bullish engulf. You see here a solid, how powerful that candle is, green candle, and you see the bearish engulf on the right hand side, encircled. It's easy, right? So the body fully covers the previous candle. Let's go to next candle, bullish and bearish harami. This is also a 2 combination, but the only difference is in this, the first candle is a red candle in a bullish harami. The first candle is a red candle, meaning open here, close lower. The next candle is a bullish candle, but it is not so powerful. What happened? Bulls opened higher than the previous day's close. Ideally, what should have happened? Bears should have opened lower, but bulls took control at the outset, right from the word go. They opened higher than the previous day's close. They took the price up, but they cannot take beyond a certain level. So the body is well within the previous day's body. That is why it is called as bullish harami. It also, people, you say that it looks like a pregnant lady. That is what they call bullish harami. So it is, next is bearish harami. As you can see on the right hand side, first is a bullish candle. So first open here, close here. Next day, ideally what should happen? If the trend is same bullish, ideally the open should also be slightly around the close or higher. But what happened? The open is lower within the body of the previous day's candle. But ultimately bears took control, but they could not take so much of control and bring it down further. So that it formed a small body within the previous body, but it is a red candle. Hence it is called as a bearish harami. So bullish harami means first a red candle followed by a green small candle. The bearish harami means first a solid big green candle followed by a small red candle where the body is within the previous body. That is called bearish harami. If one were to ask which is more powerful reversal, a bullish engulf or a bullish harami, I would say bullish engulf, because it engulfed the previous day. That means it is very powerful. Same way, a bearish engulf is more powerful than a bearish harami candle. Please understand that. There is no written rules, it is all logic and common sense. Slide 16, you can see the examples of bullish engulf, bullish harami and bearish harami, right? You can see bullish harami on slide 16, bearish harami on the right hand side. Okay. Let's go to dark cloud and piercing pattern. What is dark cloud? As you can see on the left hand side on slide 17, series of uptrend, series of 4 to 5 candles. Don't count the number of candles, it is just put some reference, that's all, right? It can be 3, 4, 5. What you have to understand, there has to be a significant uptrend. After a significant uptrend, as you can see, the 5th candle in the example is a solid green color. That means 5 days it has been going up like a steps. But what happened on the 6th day? Bulls managed to open higher like the 5th candle. They took the price also higher, but ultimately they were not able to hold at higher price, and bears took control and brought the price down. So down that the two-thirds of the previous body or more than half of the previous body, that is previous green candle, is covered. That we call it as a dark cloud cover. It is a powerful bearish candle. Why? Because had bulls been in control, they would have taken the price again and formed a green candle. But bears did not allow and they took control. If such a candle you see, it's a very good reversal pattern, and particularly if it happens during any exponential moving average or key support and key resistance levels, we can say that the trend has solidly reversed. These are all powerful candles, help you in making a right entry and exit decisions. Dark cloud cover. So thereafter you can see that it goes down for many candles. That means the trend has reversed from being up to down. That is what it is. Piercing pattern is the other way around. There is a significant downtrend. You see in the fourth candle there is a solid red candle. Thereafter the fifth candle where it moved much below the previous day's close. Ideally what should happen if bears were in control, they should have brought the price lower and they should have formed another solid big red candle. But bulls did not allow that to happen. They put the price up, they took the price up and closed solidly, nearly covering half of the previous red candle. That means bulls have taken control, and you can see that next 3-4 days powerful up move started. So then that means the downtrend is arrested, and not only that, bulls took control. It's typical again, once again the IPL example or a cricket example only. The bears were powerful, suddenly the batting team, somebody scored some 4 sixes, 3 sixes and suddenly 20-25 runs in 1 over, 1 or 2 overs, 40 runs. Suddenly things change just like that. That is called piercing pattern, right? Example, slide 18, you can see 2 examples. You see here dark cloud cover. It is also similar like a bearish angle, but it is a dark cloud cover. On the right hand side you can see the piercing pattern, right? These are all live real examples where we have taken screenshots. Let's go to slide 19. Morning star and evening star. Till now we have seen the combination of 2 candles. Now we will see 3 candles. What is morning star, evening star? The encircled one is a bullish morning star. What happened? There is a significant downtrend that happened. There is a big red candle happened. After which the next candle was a doji. What did we say? Doji means indecision. Sometimes it need not be a doji, it can be a spinning top also. Whether it is a spinning top or doji, that doesn't matter, but doji is more powerful than a spinning top. But whatever it is, after a powerful series of downtrend and a solid big red candle, if the next candle is a small spinning top or a doji, what it means? There is indecision. If they would have decided, then they would have took the price further down. That they could not do. The next candle, what happened? Bulls now took control and they formed a solid green candle. It's a perfect reversal candle. Combination of all 3 candles, that is the big red candle, the doji or the spinning top, and the first green candle, we call it as a morning star. It is a perfect reversal, 3 candle reversal patterns. Evening star is just the opposite of it. There has to be significant uptrend first, after which you see a doji or a spinning top. After which the next candle, if it forms a red candle, you can be assured that it will start going down. The trend has reversed. Of course, you have to see all other parameters. Merely you cannot say that it formed, then the trend is reversed and it will go down. Yes, the trend has reversed, but you need other confirmation, for which you have to look at other parameters. But largely candlestick alone, if one were to rely, the accuracy level will be somewhere around 60-65%, right? Let's go to the example 20, where you are seeing morning star on the left hand side and evening star you are seeing on the right hand side. As you can see on the right hand side, powerful, it's something, the upper wick is somewhere up. That means bulls took it up, but they could not hold there. The bears brought it down, and not only the next candle, you see how powerfully it goes down. That is the power of these reversal candles. That's the power of technical analysis. Please understand, learn, put efforts to learn. Next is slide 21. Hammer, bullish hammer, we call it as hammer. It is a bullish candle, and hanging man, it is called bearish. So normally what happens, you see here in the left hand side, there is a power series of downtrend red candles, which means it is a downtrend. Then what happened? The fourth candle, what happened? It opens lower and bears took the price down and a long lower wick. That means the price went all the way down lower, but ultimately bears could not hold there. Bulls came back like a phoenix and came up and closed somewhere near the open or slightly above the open, hammering out all the bears. They were hitting left, right, center, all the bears. And normally if it happens at support levels, it will be a trend reversal. And the subsequent candles, if it happens a solid next candle, solid green candle, you will see it is more like a morning star, but this type of candle we call it as a hammer. Why it is a hammer? It's like a hammer has a long lower leg, right? We use hammer at our homes and other purpose, right? The lower wick is long and there is a body, or sometimes it can be a doji also, but normally it will be a body. That is what we call as a hammer, and from there the trend will reverse. Hanging man, as you can see, whatever happens on the top we call hanging man. Normally where a man will hang, we will hang at the top, right, at the fan top or anywhere. That's why it is called that way. There is a significant uptrend, after which what happened, you see, bulls took the price, opened up, they went up but they could not hold, and they came down, the price, the bears pushed the price down, but somehow like they managed to close somewhere there. It is a hanging man. Normally when a hanging man happens at the top, it means there is a trend has reversed, and particularly the next candle, if it is a red, it means the downtrend has begun. With, of course, you have to combine with other parameters, as I said. It's a very powerful reversal candle. As you can see in slide 22, the examples of hammer on the left hand side and hanging man at the top. You can see the examples, right, at the hanging man at the top. Inverted hammer, let's go to slide 23, inverted hammer. Inverted hammer, as you can see here, down, down, down trend, a hammer, it is a hammer but an inverted hammer. As you can see in the shape, what happened, the bears opened lower, but what happened, bulls took the price up, but bulls could not hold there. Finally bears managed to bring the price down, but it formed something like a hammer, inverted hammer. Okay, so inverted hammer, after it is also a reversal candle, but a hammer is more powerful in a downtrend than an inverted hammer. But if you see the hammer the other way around, it also looks like a morning star. Hence it is a reversal candle. One has to be cautious looking at all these types of patterns that it appears every day, every moment, every time period. Shooting star. Shooting star happens at the top. As you can see in the picture, the bulls took control, and on the third day when the solid red candle when it formed, what happened, the bulls opened higher, the price went up so high, but what happened, bears could not hold there. Finally the price came down, 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 and more or less it closed below the open. That means what happened, bulls wanted to take it up, but bears took control of that. So a shooting star is very powerful reversal than an inverted hammer at the lower. That is something normally once you see more of candles you will get by practice. Let's go to slide 24 where we are seeing examples of inverted hammer. As you can see, an inverted hammer the next day is a gap up opening. That means it's a very powerful reversal, right? And shooting star, you see on the right hand side, shooting star, after which significant gap down opening. So that's a very powerful reversal. Always understand one thing, any reversal happens, when it happens at the bottom, you have to wait for confirmation, but when it is happening at the top, normally it will go in the direction, the downtrend has started. Why? Because to climb the stairs you will take time, but to climb down it is very easy. The same logic applies here, right? So let's go to slide 25, rising 3 methods and falling 3 methods. What is rising 3 methods? As you can see, first can be a solid green candle, afterward there is a sideways, a peculiar sideways kind of a thing that comes where you can put as like a straight line. Normally markets will not go up in a straight line or will not come down in a straight line. If that happens, where one will be able to see with other parameters, there will be a powerful short covering rally that will come, which will be a powerful green candle. That we call it as a rising 3 methods, right? It need not be the 5 candles that we have shown, it can be as many candles. In fact, instead of 3 red candles, it can be 4 red candles also. Sometimes it can be after 2 red candles also. So that is what I said, don't take a scale, measure and keep all those mathematical things. Keep the mathematics out of it, understand the logic, simple logic, demand and supply, right? In a falling 3 methods, first there is a red candle, the trend was down, that is what it implies. Then there is a short covering that pulled, little short covering, but it is not good enough to take the price up, particularly beyond the key resistance level. Thereafter, once again the bears came and pushed the price powerfully. So normally such a rising 3 methods and falling 3 methods candle, when it comes, the fall or rise will be very significant. You can see the examples on the left hand side, rising 3 method, bullish. As you can see here how it is rising, and you see the falling 3 methods, you can see 3 or 4 green candle, after which a solid red candle. So it's very powerful candle. Lastly, kicker, bullish kicker and bearish kicker. So unfortunately this type of candle is something which every trader the professional trader who knows candlestick thoroughly is afraid of. Why it is afraid of? I'll tell you. As you can see, there are 3 or 4. Need not be 3. Don't think that it has to be after 3 only or 4 only. There is no such rule book. Nobody is sitting and writing a rule. There are no rules. It is all demand and supply. After 2 or 3 or 4 such solid red candles, that means the trend is significantly down. Suddenly some positive news comes. What happened? As you can see in the third candle, in this case, the red candle, the open is here, low is here, high is slightly above. But ideally, what all these candles patterns you have seen till now, what happened? Ideally, the next candle is opening somewhere here or slight gap up. But here, the opening itself is higher than the previous day's high. That means very powerful reversal. Overnight when we slept, if it is a day candle, some news has come positive in the stock or in the index or whatever commodity or currency, that the trend has completely reversed. Hence it is very powerful and it is a nightmare particularly for people who are trading in the markets, because as a trader she doesn't have any control over this type of candle, whereas all other candle, if it is forming, she can put stop loss and play the market accordingly. But this type of candle has no protection. The opening itself straight away it opens with a loss. That's very important, right? Bearish kicker, it is the same thing. Bearish kicker, there is a trend is significantly up, but suddenly what happened? The next candle, it can be normally this happens in an overnight position. That means particularly on a Friday it would have been a trend up, and Monday morning you come, it opens gap down. Okay. So then that means it's very powerful reversal that happened. So as you can see, ideally what should have happened? This candle should have opened somewhere near the previous day's close, or slightly above, or slightly within, or all the type of candles you have seen. But what happened? It opened below the low of the previous candle. That means a powerful reversal has happened. So it's a very powerful reversal. Normally if such candle kicker forms, it is wiser to book losses if you are in the wrong side of it and exit and analyze later. That's what my experience tells. But this doesn't happen every day or every time period. Normally when it happens, there is some new event or news that has come. It has overwritten the existing event or news. Hence one has to be very careful, and as a trader, particularly overnight position, if somebody is taking, this is a nightmare candle for a trader. Please bear that in mind. If you are a small investor or a new person entering the market, you have to understand this type of candles form will wipe out all your capital. Please be aware of it. See the examples that I have given. These are all real examples. These are not like what you call some theoretical rules. These are all real examples that you have taken. Slide 28 you are seeing, right? So I am sure with all these things, the candlesticks, reversals and other things, you will be able to take a very good decision, understand the demand and supply, market perception. Again, I want to end with this statement. Market does not move on the basis of fundamentals, but on the perception. Perception is nothing but the mood of the market, which is nothing but the demand and supply. That is accurately captured by technical analysis, and candlestick is a powerful tool within technical analysis. Thank you very much.